Welcome, ladies and gentlemen. Let's quickly work through the theory for IAS 36, which deals with the impairment of assets. Now, not financial assets. That's a different set of thinking, and that's in the financial assets and financial instruments standards, right? IAS 36 is going to deal with impairments of PPE, intangible assets, etc. Okay, so let's have a look. Standard on a page. I've got this one printed out for you already. Important definitions. So what is an impairment loss? An impairment loss is the amount by which the carrying amount exceeds the recoverable amount. We'll go into what the recoverable amount is in a second, but you'll note that impairments are only about a downward movement. Okay, so if the recoverable amount is lower than carrying amount, we have an impairment. What is the recoverable amount? It's the greater of the fair value minus cost to sell, or the value in use. Now, fair value minus cost to sell is the market price minus cost to sell. Take note, IFRS 13 talks about fair value, right? Fair value minus cost to sell adds on to that fair value discussion because there's a new element, this cost to sell. So yes, IFRS 13 applies to fair value. Fair value minus cost to sell is a calculation for the impairment, i.e. the calculation of the recoverable amount. The value in use, this will be a discounted cash flow calculation. So, for this value in use, you will present value the future cash flows, and you must use, this is important, you must use pre-tax cash flows and pre-tax discount rates. Whenever you work with financial accounting, when you are valuing something, like a value in use, a present value of future cash flows, you must use pre-tax discount rates, pre-tax cash flows. Why? Because we have a separate line item on our statement of financial position for deferred tax, right? So we need the asset to be before tax. Then there's a bit of a discussion about what is a cash generating unit. This lecture is not going to go into any further detail about CGUs, but a cash generating unit, from a definition, is the smallest identifiable unit or group of assets that generates cash inflows that are largely independent of cash flows from other assets. Okay, so put that in the back of your mind. We'll deal with that when we look at cash generating units. Right, let's now look at information specific to impairment losses. So an impairment loss, remember, if carrying amount is bigger than recoverable amount, then you have an impairment loss. General rule is that you don't do an impairment test every year, but you will assess at each reporting date if there is an indication of impairment, okay? i.e. an indicator that a recoverable amount will be less than carrying amount. So some items you must test for every year. And when I say test, I mean you go and calculate the recoverable amount, calculate the carrying amount, and do the comparison. That's an impairment test. Some items you will test annually whether or not there's an indicator. And that will be intangible assets with indefinite useful lives, intangible assets that are not yet available for use, and goodwill acquired in a business combination. Those three you go and test for impairment every year, i.e. calculate recoverable amount compared to carrying amount and see if it's less. Then, for these impairment indicators that are so important for all the other assets, i.e. you only test for impairment when there is an indicator of impairment. What are these indicators? Well, IAS 36 gives you some internal sources, external sources, and then some items relating to groups. Okay, you can go and read those. It's quite a long list, but you're going to use some logic, right? If, for instance, you have an asset and a new technology has updated that asset, so there's an alternate asset that makes this one totally useless or out of date, well then maybe the carrying amount of this asset needs to come down. Also, if the asset has been damaged, etc., right? So there's a whole bunch of those indicators. It might be also that the market, you're in the printing press business, you spent millions on a big fancy printing press, and suddenly, the market changes to electronic media, right? So suddenly that printing press may not have such a large amount of future benefits. So the future benefits might be less than what the cost of the asset is today. Therefore, recoverable amount will be lower than the carrying amount. So those are all kind of indicators that you could think about. Good thing, go and look at those. I'll put up a list reference to one of the standard kind of summaries. Then what happens if that event that caused the indication of impairment and ultimately caused the impairment gets reversed out? Well, then you're allowed to reverse the impairment out. Okay, so here, if the recoverable amount is bigger than the carrying amount on an asset that was previously impaired, I can't just revalue. That's not what we're doing here. Then you're allowed to reverse the impairment. And again, every asset that's been impaired at some point, you will assess at each reporting date that if there's any indicators of impairment reversals, right? Take note, impairment reversals for goodwill, however, will never be reversed. That's not allowed. And you've also given some reversal indicators. Just take note, when you do this impairment reversal, there is a limit, okay? And the asset will always be limited to what the carrying amount would have been if never impaired. Okay, so you can't have an impairment reversal that in effect lands up being a revaluation. Yes, you're still allowed to revalue that asset if it's your accounting policy, etc., to do so, but then it's an IAS 16 or IAS 38 revaluation. Okay, so that's high-level standard. Let's just refresh a bit of the detail for impairments. So first, you look for an indicator of impairment, an indicating event, right? If that happens, and you find one, either an internal or external, you will then perform an impairment test, which means you will calculate the carrying amount, calculate the recoverable amount, which is either greater of value in use or fair value minus cost to sell. You calculate that, compare it, compare the carrying amount and recoverable amounts. So those are two steps. Perform impairment test. Okay. Compare the carrying amount and recoverable amount. If the carrying amount is less than recoverable amount, then there's no impairment. If the carrying amount is greater than the recoverable amount, well, then you have to impair the asset, and here's your little journal, right? You'll debit the impairment loss. Let's assume for now that that goes to profit or loss. Sometimes, if it's a revalued asset, an asset that was previously revalued above historical cost, well, then you're first going to debit the reval surplus or the gain on PPE through OCI, right? Make that reval surplus at the end of the day smaller. And then you will credit your accumulated impairment loss. So let's just quickly see what that's going to look like. I'm going to add a quick slide in here. So what do? Let's just put everything on a graph. Here's the cost in the currency units and the time, okay, the depreciation period. So I purchase an asset on day one and I start depreciating it. Okay. Then I revalue the asset. Let's do this a different color. I revalue it upwards. Okay. And guess what? I will then continue to depreciate this asset after I've revalued it. Right? And yeah, I will have values. So X versus Y, being the dollar, US, pounds, rand, whatever your currency is. You will depreciate through profit or loss, debit depreciation, credit accumulated depreciation, okay, before you revalue. You will then revalue the asset. You will debit PPE in essence, credit OCI in essence. And then you will continue to depreciate the asset, won't you? You will debit depreciation, credit, accumulated depreciation, remember, all in P&L. It's got nothing to do with OCI. And if life continued, you could keep depreciating it all the way down to its scrapping value or zero. If you had never revalued the asset, you would also have just depreciated based on the historical cost amount. But what happens now when my revalued asset needs to be impaired? Let's say the recoverable amount is much lower. So I'm going to impair it from the carrying amount all the way down to the recoverable amount. Well, here's the question, right? First of all, any carrying amount above the original historical cost carrying amount, not the original cost, historical cost carrying amount, that will be depreciated, impaired and taken through OCI. Anything below historical cost down to recoverable amount will go through profit or loss. So when I do that, I will go debit, impairment loss in P&L. That's this one over here. I will then debit, it's actually an impairment loss through OCI, and I will credit accumulated impairment loss in the statement of financial position. Okay. So if the asset had never been revalued, we would have only had an impairment going through P&L. But on an asset that's previously revalued, you will wipe out the OCI. Okay, we'll wipe out the reval surplus by debiting OCI first. Hope that makes some sense. We'll do a detailed example a little later. Impairment reversals. So here we must have an asset that was previously impaired. That's important. You look for an event indicator that the impairment should be reversed. If there is an indicator of such an event, you will then perform an impairment test, which means calculate carrying amount, calculate recoverable amount. Recoverable amount, greater of value in use, or fair value minus cost to sell. Compare the two, and if recoverable amount is still smaller than carrying amount, no reversal. However, if the recoverable amount is greater than the carrying amount, you will reverse out your impairment. Okay, there's a couple of little tricks here, and remember, there's a limit, okay, that impairment reversal cannot make the asset's carrying amount greater than what it would have been if it had never been impaired in the first place. Okay, so theory done and dusted. Let's go do a nice comprehensive example. Thank you.